thought about just a title for the presentation. I wanted to build on Chris's quarterly letter that he sent to each of you. And what came to mind was prudent patience. We've all been patient in the market, especially with the Fed and anticipated rate cuts. There's been a patience to that. And because the Fed hasn't acted, I think there's a prudence to the way the Fed is approaching the market today. And as we go through the economic commentary and looking at the market, I think we'll agree that it's a mixed bag of results. And it really does call for prudence and patience right now. So that's how I have thought about framing our conversation this evening. And let's begin as we normally do. It's amazing what a day or two in the market will how things can change. Just 2 days ago, at the end of July, we saw the markets, and I'm presenting those here. But just an update after today, we saw a sell-off in the market today. So the S&P 500 closed at about 5,447, which is a year-to-date increase of 14.5%. That's where that's a very good return year to date. Obviously, the Dow closed today at 40,348, up about 7% year to date. The Nasdaq is really where all the action has been, the return, although it was down today to 17,194, about 15% year to date. We're going to talk about a concentration of returns. So large large cap domestic stocks really have been the place where the concentration of returns have been. When we look at the Russell 2000, which is a much broader basket, obviously, of equities, we've not seen as a broad-based participation. So small cap stocks, up until the last few days, really have been trailing. We're seeing a bit of a rotation, but it really has been a concentration in the largest cap stocks. The Euro stock index, if we just look across the pond, has been up about 7.5% year to date, which is a little bit surprising to some observers of the market, simply because European stocks are trading at price to earnings multiples much lower than domestic stocks. And as we began the year, there was a sense that maybe international, this was the year that people would be looking for bargains and bid up the prices, but it really hasn't happened relative to domestic stocks. China's not been part of the equation this year. They've got a lot of issues that they're wrestling with internally, their real estate and others. And so you can see their market is actually down year to date. But if you look at all markets across the world, this MSCI All Country World Index, the average equity across all markets is up about 10% year to date. I think one of the really interesting things as we think about and look at returns, and concentration is a word that I'll use throughout our presentation this afternoon, is the concentration of returns, and particularly around AI, artificial intelligence. And there's really, it's been a driver in returns and in the market. It's no surprise there. So if we look at where the returns are coming from, the top three categories really are being driven by AI. That's information technology as a sector. That's an obvious one. Communication services is less obvious, but that includes companies like Amazon and Meta, which have been strong performers. But you might ask, well, why are utilities doing so well? And I think the answer is that AI really requires a tremendous amount of power and energy, and the utility companies are benefiting from that, responding to increases demand for energy. But once you get past those top three sectors, really, that's where all the action is, and everything else is kind of baseline, if not negative returns year to date. So again, a concentration of returns is a really important theme to what we're seeing in the market. And here's another way to look at it. Many of you may have heard or be hearing about the Magnificent Seven, or the seven stocks in the S&P that really are driving returns. And it's Apple, it's Microsoft, Amazon, Tesla, Nvidia, Meta, and Alphabet or Google. If you look at just the returns from those seven stocks, you can see year to date, it's 30% or so. The rest of the market is lagging. The blue line there represents everything else. So basically the 493 other stocks in the S&P 500 are up just 5%. So unless you own all of those Magnificent Seven stocks, it's really been hard to keep up with the market. And keep that in mind as we look at returns later in the presentation. This is an important point. If we look at just PE ratios, you can see that the overall price to earnings ratio for the S&P 500 today is around 21 times. You can see what that looks like in terms of a 30-year average. It's elevated. It's not as crazy as we've seen in the past, but it certainly is elevated at this point. I think what's interesting, though, is if we go back to the top 10 performing stocks, so not the Magnificent Seven, but if you expand it to the top 10 performing stocks, the PE ratio for those stocks today is at about 30 times earnings. The S&P as a whole, we just saw, was 21 times, but the remaining stocks, that other 490 stocks, are trading at about 17 or 18 times earnings. So there's this big gap between the largest mega stock domestic stocks and everything else. And I think that that probably is one of the primary characteristics of the market that we're seeing today. Again, I'll use it maybe for the third or fourth time, the word concentration of returns. So that's the equities. Chris had included in his quarterly letter to us the yield curve. I presented again here. I think what's important with the yield curve is to note that it's still inverted. So as we look at traditionally the spread between a 2-year Treasury and a 10-year Treasury yield, we would expect that the curve would be upward sloping, but now it's not. There's about a 30 basis point inversion in the yield curve, and we've talked about it in the past, the importance of an inverted yield curve and what that means in terms of the market, or at least the bond market's sense of where things are going. Inverted yield curves are not good. Historically, they've been a very good predictor of recessions and more difficult times. But the yield curve's been inverted now for almost 2 years. We saw it as much as 130, 135 basis points of inversion. Today, it's normalized. It's closer to 30 basis points. But nonetheless, the U.S. Treasury yield curve continues to be inverted. This just gives you a sense of what 10-year Treasuries have looked like historically over the last 50 years or so. It just puts a current yield in context for us. So let's look at the economy. And I think that the primary drivers and points of focus for market observers right now are really focused on 3 things. It's inflation, it's the employment market, and GDP. And in large part, it's because the market is focused on the Fed. And of course, the Fed is focused on these 3 drivers. So therefore, the market is focused on these 3 drivers. And as we go through each of these, I just would set the stage that it really is a mixed bag. And so let's just work through it. Inflation, we saw an inflation number come out recently as of July 11th. Inflation is at 3%. So the good news is that it continues to moderate. It kind of is stuck here in a range, but nonetheless, we're seeing downward pressure on inflation, excluding Food and energy was at 3.3%, but if you put food and energy back in, it's at 3%. That's good. But the other side of it is it's still off of the Fed's long-term target of 2% inflation. So there's work to be done on inflation. And I think it's important that when we look at inflation, we can look at CPI, but also I think that we should look at PCE, which is personal consumption expenditures. It's the Fed's favorite indicator of inflation. And what we're seeing is a similar trajectory, similar makeup in the data here. It's moving in the right direction, but it still has room to go. That's inflation, a mixed bag. Jobs. The Fed's other primary focus is around employment. And again, we're seeing a mixed bag. The most recent report shows that private payrolls have increased 122%. You could say, well, that's great. We're adding more jobs. That's really good. The problem is that the graph on the lower half of the slide here shows that wages are declining. So there's more jobs, but they're paying less. Again, a mixed bag in the data. If we look at unemployment, unemployment's hung in there pretty stable over the last couple of years at 4 or 4.1%. Down significantly from what it was, in pandemic era. And if you look at and you broaden the aperture to a 50-year time horizon, unemployment really is at record lows right now. I think the Fed is happy with the unemployment rate at 4.4% or 4%, something in that area. But it just gives you a kind of a historical context. And then lastly is GDP. As of the second quarter of this year, we saw an increase of 2.8%. I think the market has an expectation that we'll have a strong second half, third and fourth quarter, and that we may end the year with an annualized GDP growth of something around 3%. The vulnerability, and again, the mixed bag that we're seeing in the data is a real reliance on consumer spending as part of the components of GDP. Now, historically, our domestic economy has been really very reliant on consumer spending. But, as the Fed, as the market's trying to cool things off and put pressure on spending, it has also the negative effect of being negative or impactful on GDP. So again, there's a mixed bag here. We're seeing positive growth, but there's a vulnerability to it for sure. So what does all that mean for the Fed and for everyone that's watching the Fed and what their next actions might be? We had a meeting just yesterday where Chairman Powell spoke to the press and talked about the Fed. They held rates unchanged at their most recent meeting, but had hinted towards a rate cut in September. We'll see what happens there. The Fed, I think, even if they make a hint at making a change, they do that prudently. My sense is that September will be their last chance to intervene in the market or interest rates. Beyond that, they're going to be just too close to an election. They won't want to tip their hand or have influence on the election. So my sense is that we'll see something in September. If not in September, it's going to be until next year. That's my very strong sense of it. But don't take my word for it. As you ask Fed officials what they project interest rates, Fed funds rates to do over the next year or two. This is a dot or a chart that shows the dot chart that represents where the Fed governors think interest rates will go. There's a strong consensus that they're heading down from here, moderating throughout the rest of this year and early into 25, and then into 26 to be down probably something around 150 basis points or more from where they are now. So That's the expectation, but again, there's a prudent patience with the Fed, and nothing is a given for sure. So, where does that leave us as investors, as fiduciary stewards of the resources of the church's um, uh, capital? I think that, as Chris will remind us again and again and again correctly, that we should stay focused on what we know, and that is making sure that assets are allocated in a way that is commensurate or in keeping with the intended purpose of the funds. If there's a short-term need for the funds, that a more conservative asset allocation is prudent. We know what the funds are for. If it's for a perpetual need, as Chris will tell us, it makes sense to take more risk, to invest in a more growth-oriented model, and to be able to weather the ups and downs of the market, knowing that there's a long time frame. So this is the one thing that we can stay, that we do know, and Chris always invites clients to engage with him and to make sure and to revisit how assets are allocated. And I think that that's the most prudent advice given a mixed market.